Good morning, students, and welcome to our second class of the winter school. It's quite chilly out there, so I've decided to put my gown on again, so I'm quite cozy at the moment. We are going to finish our discussion on the conceptual framework first. Then we're going to have a little 5-minute break. The reason for that is I just want to stop this recording, reorganize a few things on my side so that I can start a new recording when we start our discussion on IAS1. It's just for practical purposes that I can load it to various or different folders on Blackboard. Before we start, perhaps I can just ask whether there are any questions from your side regarding Tuesday's lesson. You're welcome to ask it in person. You can just raise your hand and then you can speak, or you can type it in the chat box if you wish. So are there any questions? No questions from your side? Okay, doesn't seem to be any questions. Then we're going to carry on where we finished last time. So let me just go and find the conceptual framework again. Right, you should now see the beginning of chapter 5, the contents table of chapter 5. We finished with the definition of the 5 elements yesterday. So today there are 2 further matters that we will be discussing. The first being recognition and derecognition, and then there's also the matter of measurement. During the course of today, I have to give you this early warning. I'm going to require of you to take a few notes because we are going to summarize some of the long explanations within these 2 documents, but I'm also going to provide you with some additional information, more information than appears in these 2 documents. The reason for that is we also have to look at IAS 18, which deals with revenue, especially when we get to IAS 1. So if you can just have a pencil or pen and a piece of paper handy or a notebook, because you will have to take a few notes later on. Okay, so let's just talk about what is meant by recognition and derecognition. Recognition refers to the process where you are going to record an event or a transaction for the first time. That is meant by the term recognition, right? So it's not I'm recognizing, hi Paul, I know you. Recognition means you are going to record a transaction or event such as the acquisition of an asset or the acquisition of a loan for the first time in your books of account. Derecognition is exactly the opposite. So let us use a few examples, or perhaps one comprehensive example here. If you acquire a non-current asset, let's say, for instance, you are going to acquire a delivery vehicle, a vehicle that is going to be used to deliver your merchandise to your customers. As you know, that will be a non-current asset. That will be part of property, plant, and equipment, which we're going to be dealing with in this upcoming term. So then, how do you recognize it? First of all, you've got to calculate what is the cost of that asset. When we are going to do IAS 16 with property, plant, and equipment, we'll see the cost of the asset consists of the purchase price, directly attributable cost, as well as something we refer to as certain future cost. But anyway, we'll get to that in terms 3. The fact remains you have to calculate what the cost is, and then you've got to decide how am I going to record this for the first time. So if that had been a cash acquisition, you know you will debit the cost of that particular asset and you will credit your bank account. Now, during the period that you actually use this delivery vehicle, at the end of each year, you are going to calculate the depreciation. You have to make a few estimates. Like we said on Tuesday, you'll have to estimate the residual value. You'll have to estimate the useful life of the asset. You'll have to decide upon a specific kind of depreciation method, and then you're going to depreciate it after year 1 and after year 2 and after year 3. So in each case, you are going to debit an account called depreciation, which is an expense. You close that account off to profit and loss at the end of the year. And in each case, you are going to credit an account that refers to that specific asset's accumulated depreciation. And that doesn't get closed off at the end of the year. That gets balanced off at the end of the year, and the balance gets carried forward from the one year to the next. So when we talk about derecognition, this is normally either when you dispose of the asset or when the asset has become worthless to you. Then you have to derecognize that asset, which means you are going to get rid of any balance that relates to that asset. So now you have to get rid of the cost of the asset. You know it has a debit balance, so to get rid of it, it means you have to go and credit the cost account. In the case of the accumulated depreciation, we know that will have a credit balance. So to get rid of that credit balance, it means we have to go and debit the account. So that at the end of the day, the derecognition process has the result that your cost account has a zero balance and the accumulated depreciation account also has a zero balance. Okay, so that is what is meant by recognition. That is recording a transaction or an event such as an acquisition of a non-current asset for the first time in your books of account. And derecognition is when you get rid of those balances once you dispose of that asset or if it had become totally worthless to you. Just a few other things that we need to discuss surrounding recognition and derecognition. The conceptual framework also gives us guidelines when we should recognize a transaction or an event. I'm just going to scroll down. There's a specific paragraph. This just gives you all the background. I'm just looking for a specific paragraph that I'd like to highlight. There we go. They call it the recognition criteria. So I can perhaps just highlight it there. The recognition criteria. When are we going to recognize any transaction or event? Now, clearly, first of all, it must comply with the definition criteria. So it must comply with the definition of either an asset or a liability or equity or income or expenses, right? So once it complies with one of those definition criteria, then we refer to the recognition criteria. So then we decide, should we actually record this, or the new term that we've just learned, should we recognize this or not? And the recognition criteria basically tells us we are going to recognize it, we are going to record it if two situations exist. And that is, the information must be relevant. You remember we spoke about that under the fundamental qualitative characteristics. So that means it must have that characteristics that is fundamental, right? So it must be relevant. And you also know what the second one was. Let me just scroll down to it. It must also represent the matters, the affairs of the company faithfully. It must also then provide us with a faithful representation of either the results of the company's operations or its financial position or its cash flows. Right, so those are the important paragraphs for us. I'm going to scroll down to the next chapter. You also now know what derecognition is. Derecognition is just getting rid of all balances that relate to the item that you no longer own or the liability that you no longer owe. So then let's get to chapter 6. Just before we get to chapter 6, let me just check from your side. Are there any questions? Again, you're welcome to either type it. I'm looking at the chat box. There's no chat messages yet. Or you are equally welcome to ask it in person. Okay, doesn't seem to be any questions, so let us carry on with chapter 6, measurement. Now, there are two broad measurement bases allowed by the conceptual framework. Just before we start looking at them, we must just remind ourselves of what we discussed on Tuesday. We said that the conceptual framework forms the foundation of the other standards, but we may find there are other measurement bases in the subsequent standards. But those further measurement bases only relate to that item which is covered by that particular standard. So these measurement bases that we are going to be discussing this morning relates to everything, but it's not the totality of all bases. There may be further bases, but then they only relate to a specific kind of area in your financial statements. Again, if we can use an example here, IAS 16, I'm using that as an example because we are going to be covering that in the third term, which is starting in a couple of weeks' time. There they go further and provide us with some additional measurement bases, but those additional measurement bases only apply to items covered in IAS 16, and we know IAS 16 deals with property, plant, and equipment. So these measurement bases in the conceptual framework covers any kind of element, but there are certain elements such as property, plant, and equipment, which you know is an asset that have some more possible measurement bases, but then those will then be defined in that particular standard, such as IAS 16, and then those additional measurement bases will only apply to that particular item, such as property, plant, and equipment. Okay, broadly speaking, there are two measurement bases that are allowed. We're going to discuss all of them. The first one is the historical cost basis, right? The historical cost basis, we're going to talk about that soon. The second one is a current value basis. A current value basis. So this is the historical cost basis, which we'll explain just now, and there are a number of current value bases. There are three possible current value bases. The one is the fair value basis, which we will discuss soon. The second one is the value in use and fulfillment value. Very often we just talk about the value in use. And then the third current value method is the current cost basis. Okay, so let's go and have a look at each of them. We must know those bases, the various measurement bases, but we must also understand what they mean. And this is possibly a good idea now to start taking notes, because as you can see, when it comes to historical costs, there are many paragraphs and pages that cover that. Actually, probably just about a page and a half, but many paragraphs. So I'm going to summarize it for you. What is meant by the historical cost basis? This is the most popular basis. This is the one used in most cases for assets as well as liabilities. But there are exceptions where a different base might become more handy, and we'll talk about that. So the historical cost basis, like I say, that is the most commonly used one and the most popular one, is simply, and here you have to take a few notes, please, if you're ready. Historical cost basis simply means you are measuring the asset or the liability, the acquisition thereof, simply at its cost. At its cost, what it cost you as a person or an entity like a company or a CC, what it cost you when you acquired that particular asset or when you acquired that liability. So what did it cost you historically? What cost did you incur to acquire the asset? And like I say, when we get to various kinds of assets such as inventory or property, plant, and equipment, then we will determine exactly how you determine the historical cost. In general terms, And this applies specifically to inventories, property, plant and equipment, intangible assets, biological assets, financial assets. Basically, it means it is the purchase price. So firstly, the purchase price, and then secondly, what they refer to as directly attributable cost. Now, how we determine directly attributable cost, we are going to be doing in the third term when we do property, plant and equipment. So there we're going to explain and understand exactly what is meant by directly attributable cost. And your purchase price is very simple. The purchase price is simply what did I pay for it, or what am I going to pay for it? So if it's a cash acquisition, what did I pay for it? Or if you acquire it on credit, what am I going to be paying for it, right? So in effect, historical cost means what it cost you to acquire the asset, and that includes specifically your purchase price. Now, the historical cost basis is very appropriate for things like motor vehicles, which deteriorate in value and quality over time, or plant and equipment, which also deteriorates in value over time. The more you use the plant and equipment, the more exhausted it becomes, right? So it becomes, it decreases in value over time. However, there are certain assets that do not lose value over time. Some assets actually gain value over time. Now, there is one very obvious kind of asset that gains value over time. So I want you to type in the chat box for me, what do you believe is a typical kind of asset that over time becomes more valuable? What kind of asset increases in value over time? If you can type for me there, please. Type for me some description there. Don't be shy. There we go, Bradley Bizwapi. Land and buildings, typical. Molatisi Milani, you're also very awake on Tuesday. Land and buildings. Masibonku, quite correct. Land, right. Land, buildings can possibly deteriorate over time. There's nothing that's permanent. Well, nothing in life is really permanent, so I shouldn't even be going there. But you are all correct. Land, buildings. I'm probably more specifically referring to land as such, immovable property. If you bought a dwelling, a house, let's say in 1980, which is now 40 years ago, you bought a palace for 30,000 rands, and today you can sell it for probably R1 million, right? So it appreciated. It didn't depreciate. It appreciated. It is worth a lot more. So therefore, would it be, I just want a yes or no answer here. You can just say yes or no. So if you want to have a fair reflection, a faithful representation, let's say, of the financial position of the company, which include the asset value, and you purchased this piece of land in 1980, 40 years ago, for 30,000 rands, would it be appropriate to still show it here in 2020 at 30,000 rands value, or would that be a misrepresentation? So just tell me, is it yes or no? Should we still use the historical cost if we want to fairly present the financial position today? Yes or no? We've got a difference of opinion here. Molatisi Milani says yes. Nomi says no. Mbuyisi says no. I think the majority is correct in this case. The answer is no, because if it is truly worth R1 million today, the faithful representation of your financial position would be that it is worth R1 million. That is what you want to disclose in your financial statements, your statement of financial position in particular. So the 30,000 rands that you paid for it 40 years ago has almost become irrelevant, right? So therefore, in the case of something like land, an asset like land, the historical cost will probably not be an appropriate basis to use for measuring your non-current assets, right? It might be appropriate for motor vehicles. It'll definitely be appropriate for motor vehicles as well as plant and equipment and many other non-current assets. But in the case of land and to a certain extent possibly buildings as well, it might not be appropriate. So there we'll have to go and look at some of the other measurement bases or the other measurement bases, and there we have a few choices. So we'll have to use some sort of a current value basis, a current value basis. And as we've seen, there are three possibilities, the one being a fair value, which I think is very appropriate in the case of land as well as possibly buildings. The other one that we've mentioned is value in use, and then the current cost. So let's discuss the differences between those. So a current value measurement, any of those current value bases can be either one of those three. So let's start with a fair value. What is meant by the fair value? Perhaps you can take a few notes here again. It's quite a long story, but I'm going to describe it as concisely as possible. The fair value is basically what you can sell the item for if you dispose it on an open and free market today. So if you can just make a little note there, the fair value is the amount that you can dispose of the asset if you should sell it today on an open and free market. What I mean by an open and free market, it is not a forced sale. So in other words, the company has not been liquidated or the individual has not been sequestrated. So it's not being put in an auction where people will fight over the price. So it's a free open market, what you can sell it for today. So that is the fair value method. That provides you with one way of calculating a current value for that asset. The second possibility is what we refer to as the value in use. Now, again, that is something we're going to be looking at again in term 3 when we are studying property, plant, and equipment. We're also going to look at that in financial accounting 3, in fact. The value in use for an asset or a liability, but let's maybe focus on assets because that's easier to explain initially. The value in use is what value would that asset provide for us if we continue using it as we have in the past. So again, if you can just make a little note there. So the value in use is what value. So here we can think future economic benefits. What economic benefits can this asset provide for us if we continue using it into the foreseeable future as we have in the past? Now, I don't want to again go too much ahead of ourselves, but when we are going to be discussing property, plant, and equipment in term 3, which starts in about 10 days' time, we are going to look at fair value and value in use when we do something we call an impairment test. So just maybe somewhere make a little mental note of the word impairment test, because we are going to discuss that fairly soon within the next month or so. So fair value is what you can sell it for, and value in use is if you continue using it, what economic benefits does it provide us? Now, you'll also, this should also ring a bell with regards to something we discussed on Tuesday. We said when we discussed the term going concern, you'll remember we spoke about the going concern assumption. So when a company is a going concern, it means they are going to carry on trading into the future as they have in the past. So the appropriate value to use, if we are using a current value, the current value basis, if we are not using historical cost, is then to measure your assets and liabilities at the value in use, because you are going to keep on using them. But if the company or the entity is not a going concern, if it is going to be liquidated, or if the person is going to be sequestrated, or if they're going to stop trading, it means they will be selling those assets in order to pay their liabilities. Then the more appropriate measurement basis to use, if you are using the current value basis, is then not the value in use, but rather the fair value of the asset. What can I sell it for on an open market today? Then the third possibility is the current cost basis. The current cost basis, which is also a current value method. The current cost basis is simply where you measure the assets that you own at the cost in which you can purchase a similar kind of asset today. Right, so now we're not looking at the fair value, in other words, what we can sell it for. We're not looking at the value in use, in other words, what future economic benefits can it provide us if we keep on using it. We are looking at what is a similar asset going to cost us if we purchase it today. And when I say similar asset, it really means similar asset, not a new one, but one of the same age. So if you are talking about a 3-year-old Volkswagen Golf, what will a 3-year-old Volkswagen Golf cost you if you should purchase it today? And that will then be the current cost measurement. Okay, ladies and gentlemen, I think that is all we need to discuss with regards to the framework. We have spoken about historical cost, we've spoken about the current value method and all the various possibilities under that. The next few paragraphs, or the next paragraph, I should say, deals with, I think, capital. Let me just make sure that I am correct. That still has to do with measurement. Cash flows we will discuss in the fourth term. Oh yeah, just presentation and disclosure. And that's the other one we just want to briefly discuss. Presentation and disclosure, it normally refers to your financial statements, but there is a small little difference in emphasis about what is meant by presentation and disclosure. Presentation normally means how do you present something on the face of your financial statements, right? And if I use the term the face of the financial statement, it means the main body of the statement, as opposed to the notes that accompany the statement, right? So again, if we can use the example of property, plant and equipment, because we are going to be doing it in the third term, I know I've already said that. The presentation of property, plant and equipment is that you will have, under your non-current assets heading, you will have one line item simply called property, plant and equipment, right? So you will describe it on the face of your statement of financial position under non-current assets as property, plant and equipment. That is how you present it. But then, as we'll see in IAS 16 in a month or so's time, there are further disclosures required. There are additional information items that needs to be disclosed as well. For instance, for each category of property, plant and equipment, and if I refer to a category, something like motor vehicles or plant or equipment or office furniture, land, as you've mentioned, buildings perhaps, for each of them we have to provide additional disclosure, such as its cost or its revaluation value, which we'll talk about in a month or so, its accumulated depreciation, something we'll learn about soon when we do PPE, its accumulated impairment losses, and its the difference between your cost and your accumulated depreciation and your accumulated impairment losses then provides you with a carrying amount. So those are additional items that must be disclosed, but not presented on the face of your statement of financial position, but rather in the notes to financial statements, right? So the additional disclosure will appear in the notes. So there you will provide more information with regards to each item that has been presented on the face of your statement of financial position or statement of comprehensive income or statement of cash flows and so forth. Okay, that concludes this discussion. Paragraph 8 just deals with the concepts of capital and capital maintenance. That is something we will discuss sometime in the future. Okay, ladies and gentlemen, I'm going to finish this part of our class today. We are going to take a little break soon, but just before we take the break, there are perhaps a few things that I'd just like to do before we take the break. First of all, I just want to ask you, have you got any questions on what we've been discussing so far today, or even again on Tuesday? If there are any questions, you're more than welcome to raise your hand and ask the question, or otherwise you can type it in the chat box. No questions? Perhaps I've got something, just one last thing that I'd like to say. As you know, your class test, which is on, what's it, the 18th, I think, the 18th of August, Tuesday, the 18th of August, covers this conceptual framework, right? It doesn't cover the work that we're going to start with in a few minutes' time. It just covers the conceptual framework. Now, I think I've got a little surprise for some of you. Many students may ask the question, are we all going to write the same paper? What would you say? Give me an answer there. Do you think you are all going to write the same paper of the class test? Yes or no? Type for me there. Yes, we're all going to write the same. You don't have to type the whole sentence. Yes or no? Yes or no? Airway. Thank you, Frankie. Airway, but you are not correct. Mbuyusi said no, and Mbuyusi is actually correct. In fact, you each are going to get your own little individual paper. No two students even will have the same paper, because we're using a technique that is called randomized pools. So as soon as a particular student starts writing it, the question paper is designed individually for that student. It draws from a random pool of questions. So if you are going to get 25 questions, there's possibly, I don't want to exaggerate, there's possibly 120 different kinds of questions that the system will randomly pull from that pool, randomly pull from the pool, if you know what I'm saying, pull from the pool of questions to design your own personal question paper. So I'm just giving you that as a little warning, so that you do not think that you are going to be writing the same paper as anyone else, right? I saw that in financial accounting, a test that was written a few weeks ago, where it was apparent that students thought they were going to get the same paper, and they were quite shocked when they realized each one has a different paper. Okay, any questions from your side? Right, then I'm just going to have us take a 5-minute break. It is 11:35 now. If you want to leave for a while, or if you want to remain in here, it's also good. We're going to take a 5-minute break. So at 11:40, we're going to recommence. I just want you to stop this recording and start a new one.